Good morning, everyone, and welcome to our AGECO, market update. Today we have John Robinson first. He's going to talk about cotton market update. Then we have Yuri Calil. Yuri is gonna give us an update on grains. And last, we have David Anderson, who is going to give us an update on livestock markets. As always, remember, you have any questions that you have, please, feel free to ask as much as you want. And hope you are enjoying your summer. You all had a great weekend, and you all having a lot of rainfall. So, John, whenever you want to start.
All right, thank you, and good morning to everybody. So we'll start off, as you can see here on the right side of this chart, cotton prices, the futures contract prices for the old crop, which was last year, the 22 bales, which are they've mostly been sold, and most of them are probably going to get shipped out. The prices for those old crop bales have kind of been trading in the mid 80s now for a while, a few cents higher than the red line prices, which are the new crop prices. That's the December contract. But both of them have been going sideways in a very relatively tight range bound is what we'd call that. It's not surprising that they're range bound, and it's not surprising that the old crop is a little bit higher than the new crop, given the supply and demand outcomes that we use to predict prices, which you can see in all these numbers. What I want you to look at is the middle column of numbers and the right-hand side column of numbers down at the bottom where it says ending stocks. The old crop ending stocks are a little bit tighter. They're at 3.2 million. That's the leftovers after we grew the 22 crop and added it to what we started off with and exported what they think we'll end up exporting out of it and spun domestically. What's left over is 3.2 million bales, the ending stocks. And 3.2 is, it's modestly tight. It justifies prices being in the 80s. And 3.2 is a little tighter than 3.5 million, which is what USDA is projecting for the new crop. Now they're projecting that way in advance, so that could change. But just right where we are now, both of them are kind of in the same neighborhood, and that's why it doesn't surprise me to see prices pretty close to each other, but the old crop a little bit higher than the new crop because the old crop ending stocks are a little tighter than the new crop. I think the old crop numbers aren't going to change very much. We're at the end of the marketing year, and so they may tinker with the export number as they have been for the last few months. And exports for old crop have been pretty good. The new crop export and new crop demand outlook I'll talk about in a second. There's more questions about that. There's also other questions, a lot of questions about the new crop supply picture and what the production will be. So I'll get into that next. So again, just a quick refresher, cotton consumption goes up and down with the general economy. This blue line is the per capita consumption of cotton in the world by the average consumer, and it fluctuates between 6 pounds per person per year and 8 pounds per person per year. That's, you could think of that as a half a dozen cotton shirts. It fluctuates up and down, and it generally goes down whenever there's a recession, like here above the dot-com recession. When that blue line takes a dip, that means per capita cotton is going down in a recession. And in the Great Recession, there's a dip in the blue line cotton consumption. And in the pandemic recession, there's a dip and then a recovery and then another dip in the cotton consumption. And we're at the low end of the range. I think kind of reflecting that we're kind of in a period of relatively slow growth, and there's fears going forward about a recession. Now, this green dotted line over here on the right-handed side is actually a forecast of not a recession, but just of slow growth. Slow growth in the world at 3%. That's fairly slow growth. And that to me, I would call that a headwind for cotton. It's the lack of a boom period. It's not economic boom, so I wouldn't really think that it's going to pull up much on the cotton market from the demand side. And one of the reasons I'm kind of concerned about that, and others, the people that forecasted that, are looking at this. This is the inflation. This shows the climb in this blue line, and the peak of this blue line is the peak of inflation earlier this year. And all those little plus numbers are the interest rate hikes. That's 1/4%, 0.5%, 0.75%. That's all the interest rate hikes that the Federal Reserve has been doing to tame inflation, basically to put the brakes on economic growth, which it has. And inflation has come down from 9% to 5%, but keep in mind that the target rate of inflation is 2%, which means that the Federal Reserve's not through putting the brakes on the economy. They're going to hold on to these interest rate hikes. They may raise interest rates more, or they may just hold on to the hikes that they've made, and that's going to have the effect of slowing the economy, and that ought to be a headwind to cotton demand. And we may not feel it for 6 months or a year. These things are lagged, but again, I'm not looking at the demand side as being what's going to pull up on the market because of this. Basically, because of this, I'm expecting this to be a headwind, a bit of a drag. That's the demand side. I'll skip that. Now, here lately, we have had pretty decent demand, as reflected in these blue peaks and valleys here represent bales of cotton sold per week as export sales. The scale is on the left-hand side. So, we've had a few weeks where we sold 300,000, 400,000, and last week it was reported that export sales were over 450,000. It was a marketing year high. So, this looks pretty good, but what I submit is this is sales of the old crop, which is kind of in a tight supply situation. It's the end of the marketing year. I think this is going to fizzle out, and we're going to shift to the new crop situation and the new crop supply and the new crop demand. And I think the demand influences for the new crop aren't as rosy as is reflected by this. I'm glad this is happening over here on the right side here. I'm glad that these peaks are happening, but I wouldn't look at that and say that's I'm going to predict the future based on this. I think this is sort of a legacy of demand normalizing and coming out of the pandemic and things normalizing. But I don't really think this is necessarily a way to judge what future demand's going to be. And part of the reason I think that is because when we look at sales of next marketing year, export sales for next marketing year, we're behind the pace. Right now, we've only sold 1 million bales for the next marketing year. And at this time a year ago, we had sold 3 million bales for the next marketing year. So we're already showing kind of a lag looking out into the future. So again, we'll have to see. I just don't expect the demand side to be what's pulling us up. All right. When we think about what the new crop situation is, the big question for a while, it's still a question, was how many acres we're going to get planted. All the prospective surveys, prospective plantings, planting intentions, things indicate 11 point something million planted, which was more than I expected, given how much better the price of corn was and soybeans relative to the price of cotton. I expected big cuts. Now, I still hear anecdotally stories of big cuts in the Delta, in the Southeast, and in Texas. They're not reflected in any of these prospective planting surveys. Maybe they'll be reflected in the next planted acreage survey, which is coming up at the end of this month. So we'll have to see. But, if there's a shock, if there's a big reduction in planted acres below 11 million, then that might be a shock to the market that might jar prices up a little bit, because it would potentially tighten up the supply picture. All right, that's planted acres. Regardless of what the planted acres are, we've got another problem. There is just a huge switch towards uncertainty about what's out there beyond planting, and it has to do with the turn in the weather. We were dry, we were in a drought, and then West Texas got 20 inches of rain in 6 weeks. West Texas got their annual total of rain since Easter. Okay, well, as you can imagine, that'll mess with planting, and it has reportedly messed with planting in certain parts of the state. I'm going to go from south to north. Down in Yuri's world, all the way to the Rio Grande Valley, they got a lot of that rain. They had already planted, and in some places it did get too wet, but for the most part, the heat units are there. The crop is growing, progressing. I've driven around a little bit to the valley and back, and I'm going down to the Gulf Coast today and to Palacios. And every time I take a spin down there, things look pretty good. They look pretty lush to me. The computer modeling that the researchers are doing at Corpus is indicating good growth and development, and I'm expecting good things out of the South Texas crop. So if things continue, they're off to a good start. Central Texas was maybe some prevented planting. They were definitely late planting. I'm assuming they're progressing. The real question is in the rolling plains and the area south of Lubbock, which we've got experts on that who could comment more than I could. But the planting deadlines aren't quite here yet for those regions. And from what I hear, there are a lot of late season seed sales by cottonseed suppliers into those areas, and indicating that growers are trying to plant cotton at the last minute. They're trying to plant cotton in between the rains, but they want to plant cotton. Okay. If they plant all their intended acres, then the question is this rain a net benefit? I would assume that it would be. So we may have lower than normal abandonment and higher than normal yields on all this dry land acreage in the rolling plains and in the sandy land regions below Lubbock. Okay, so we got to figure that into the equation. But then the last part of it is the opposite. Early planted stuff above Amarillo and others planted stuff, or there was stuff north of Lubbock, between Lubbock and the top of the Panhandle, that A, never got planted, B, got planted and failed. Probably some of it got failed because of drought. Some of it's going to get failed because of wetness. So that stuff, I have heard estimates that boggle my mind of basically 50 to 75%, depending on how far north you are, of what was intended for cotton is not going to be in cotton. It's either going to be fallow, or it's going to be planted to a short corn, or it's going to be planted to sorghum, or it's going to be planted to some forage. Those are big numbers in a cotton intense region. So I don't think this has been figured into USDA's current equations. They're projecting a 16 million bale crop based on fewer acres abandoned because of the moisture. Well, and what's happening in the Panhandle basically is a net detriment of the moisture, and I don't think USDA has incorporated it into their calculus yet. And frankly, I don't think we'll have that great of a picture even after the June 30 planted acreage report of what's out there. I think it'll take all summer. I basically think it'll take all summer for the market to figure out what kind of a crop we have out there and how big or small it is. That kind of uncertainty, generally, it's going to hold up prices. I mean, there's a good effect of it. I think the December 23, which has been trading like at 81 or 82, has a pretty good chance of bouncing up to 85 and bouncing up to 88, making a run in the direction of 90 cents between now and, say, September, just because the market doesn't know what's out there. So if something happens to spook the speculators, they may jump on a bandwagon and buy the market up, and they have the power. A couple double limit moves could put us in the upper 80s, and so I think that's possible. I think that's possible until the market figures out what size of a crop we have. The demand question is kind of still a question. Will things be weaker, or will they kind of stay where they are? That remains to be seen. If we do have rallies, I think they're going to be volatile weather market kinds of rallies. So if they shoot up to the mid 80s to upper 80s, I wouldn't, if I was a grower, I wouldn't hold on to that cotton unpriced, thinking it's going to go to 90 and stay, or go to 95, or go towards $1. These weather market kinds of influences come and go. They don't necessarily last. And this is just an example. I put this in here to show you. I want you to look at these green upward spikes. What those are weather market summertime rallies that the red line is price. The green line are speculators jumping on a bandwagon, buying the market up. And they do that every summer. And they do it particularly in summers when they're worried about how the crop is doing. But you know, these things last. Those teeny little upward spikes up there, those are 3 or 4 weeks long. They come and they go. And I think we'll have some of that this summer again, which may take us to the upper 80s towards 90. But if I was advising a grower, I'd be saying, you know, sell some of it, sell a quarter of it, sell a third of it during the rally. You know, anything above 85 cents, I'd be looking as pricing opportunities. And that's all I got. So I'll hang around for any questions anybody has. But I'm going to stop sharing. Pancho, you're muted. Yeah.
Yeah. Thank you, John. Thank you very much. Hey, there is any questions for John? Yuri, if you want to upload your slides. John, meanwhile, one quick question. When are we going to have, basically, what will be the deadline to know, are these acres, you know, how many acres are going to be planted in Texas, or when it's too late?
Well, for some areas, we have a pretty good idea based on the numbers that are collected by the Boll Weevil Foundation people. Up in your world is where we really don't have an idea about what's been planted until probably into July, because people can plant up until a June 20 deadline, I think, in the rolling plains, parts of the rolling plains. And then there's 10 days of waiting until the crop insurance adjusters get out there. And, you know, so basically it's well into July before we're ultimately past the deadline. And then it's up to the growers might certify those acres. It may show up in a certified acres report at FSA, but that's an underestimate of what's out there because not all the growers certify. So to be honest, it'll be probably August.
Okay.
Before we have it'll be the mid-August supply and demand report before we have the first real guesstimate of what the planted and harvested acres are.
Thank you, John. Yuri, whenever you want to start?
Yeah, are you seeing my slide?
Yes.
Everything's all right. Good. Good morning. Thank you for having me, Pancho. Good morning for everyone. That's it. Oh, I don't see my slide moving.
I can see you're muted now, Yuri, but I can see your slides.
Wait a minute. Here we go. Can you see it? That's it.
Yes, we can all see them.
So my idea today is to give an overall idea of the grain market, talk a little bit about supply and demand, highlighting trade and weather. My basic argument will be the following. The supply will outstrip demand, so the price is going to trend down. That will be the basic idea. And I'm going to conclude foreseeing what we think where the price is going to go. So that's a little bit about the history of the prices. As we can see, after Russia invades Ukraine and the ratio, Brazilian drought, the prices spiked. So now they're trending down, and they're about the same amount they were before, and a little bit more before the Russian invasion. That's the picture now. So since the price spiked after Russian invasion, bring a lot of incentives to people to plant. So you guys can see over here that we have 81 million acres planted, more nowadays than 2019, 2020. To have an idea, 21 million acres more is the same area that Brazil and Argentina allocate to corn. So high prices brings incentives to plant and produce more and more. And in fact, that's happened. The same way we can look over here, the prospective planted acres, corn, soybeans, and rice has been increasing in US, and wheat, a big increase for wheat. but cotton and sorghum lose area, mainly from corn. So let's look to see what the USDA is looking for in the future. The first news over here is yield. If you guys look at the yield, we are projecting a record-breaking year, 108.1 bushels per acre. That's a 4.7 increase over the last year. Also, we're going to see an increase in harvest acreage as well. So if you're going to look to supply, given this yield, we're going to have another record over here in production, 1.5 billion bushels of corn. That's 11% more than the previous years. Is another record. Since we're increasing production, we're going to import less as well. So the total supply is going to be 1.6 billion bushels. However, the same thing or the same growth will not be witnessed by the demand side. As you guys can see over here, we're going to have only 3.6 increase in domestic use, going to 12.3 billion bushels. And we're going to increase exporting by 2.1 billion. So the figure is the following. The supply is going to be 16.7 billion bushels and demand is going to be 14.4 billion bushels. So this unbalance is going to kind of swell the ending stocks for almost 60%. That's a lot. So since we're going to have a lot of more ending stocks, that's going to affect the prices of corns dramatically. So prospective planting of corn. As you guys can see in this graph, in the blue bars, 2023, we are increasing. And the growth comes mainly from the South and from the Dakotas as well. So unplanted corn acres by June 4. Well, I would like to call attention about Kansas, Illinois, Nebraska, and North Dakota. This is not planted as they think they would plant, but until now. Part of the explanation comes from the drought monitor. As you guys can see, in the region of Nebraska and Kansas are more drier, and the overall region is become more drier as we're going into the summer than we expected. So that may change a little bit the things. Another thing about the weather, just out of curiosity, I read on the Wall Street Journal like 3 days ago about a program, cloud seeding, here in the West Texas Weather Modification Association. 6 counties are doing cloud seeding, which means that they can increase the rain by 15%, just out of curiosity. So that's the victory of agronomy, the development of technology. We see the increasing yield over the years like a beautiful linear trend, and we expect over 108 bushels. That's a lot. That's a victory. Well, where we are using the corn, after the biofuel area, we have a lot of going on for biofuel. We see an increase for feed and residuals, but since we're producing a lot, we also see an increase in exports. But as you guys can see over here, the end stock's gonna jump pretty much as well. So let's talk a little bit about trade. China imported a lot of corn from the US. And by the way, US is the main exporter for China, of corn. And China is diversifying away from the US. Last year, they imported 70% of China imports came from the US. But they are trying to diversify away. They are importing a lot from Brazil. Another US partner is the Mexico. And Mexico did a decree that they would not buy GMO corn. By 2024, they say we will not more import GMO corn. There's a dispute. Hi there.
Sorry, Yuri, I cannot see your slides anymore. I don't know. Is anybody else can see their slides or it's just me?
Wow. You cannot?
Maybe it's just me. Now I can see your sharing.
No, I'm sharing again.
Excellent. Thank you.
Are you seeing?
Yeah.
So I don't know. Well, what I'm talking about is that Mexico did a decree. They say, well, we'll not buy more like GMO corn. U.S. is disputing that, but Mexico is the second major importer of U.S. Corn. So also this chart over here brings the linear correlation between income and grain. So as oops, wait a minute. As you guys can see, for each 1% growth in income, we have 3.8 increase in consumption of corn. So that's a lot. So if the economy goes well, the consumption of grains goes well as well. So that would be the idea. But as Robson said, the economy is moving sideways. No boom, no nothing. And by the way, Goldman Sachs predicts 25% of recession in the next 12 months. And Wall Street in general predicts 65% of chances of recession in the next 12 months. So here is the big puzzle, right? They are increasing the interest rate. They see the inflation decreasing, even though the goal would be 2%, but unemployment is still pretty low. What does it mean? It means that people are employed, people are making money, so people are going to spend money, which keeps the economic wheel turning. Well, one good way to predict the price is to look at days of use on hand at the end of marketing year. So as you guys can see over here, US has been increasing since 2020 the days of use on hand. And why this is relevant, all right? We have this benchmark of 40 days. When the days of use on hand is on our left-hand side, we see that the price is going to be a little bit higher. When they are on the right-hand side, the price is going to be a little lower. Well, last year we have the prices around $6 and almost $7 per bushel. And the upcoming year, we expect the prices trending down about 4.5, 4.8 or dollars per bushel. That's the way we foresee the prices. But also, since the biofuel era, we have a lot of volatilities. And also we can see the prices like return to the mean or converting to the mean of the previous years. So what is the idea? We have a higher price, higher input cost, we have tight margins. But what's happening is that supply is bigger than demand, so the prices tend to be lower. And also about the global economy and global trade is still a lot of uncertainty. So the message is the following. We foresee the prices trending down because there's a lot of production and we don't see the consumptions growing as they should because the economic situation. That's my message, Pancho.
Yuri, thank you very much. There. Hey, thank you very much, Yuri. There any questions for Yuri? If not, David, are you ready to start?
I'm ready. Can you hear me okay?
We can hear you okay, yes.
How's that? You see that okay,
Perfect.
Pancho?
Yes, perfect.
Well, hey, thanks, guys. I'm having to do this from my Jeep today. I had to go to the doctor this morning for my annual physical, so I'm sitting out here in the parking lot. And of course, hopefully it won't be too loud. Of course, now that I've fixing to talk, the lawnmowers have shown up here at the doctor. So let me know if we have a trouble hearing this. But anyway, it's great to be with you guys today, and thanks for doing this every month with us. I find this to be pretty fun, and hopefully it's useful as well. Let's jump into livestock markets. Maybe. There we go. Heck, it seems like just about every week we've got another record high in fed cattle prices. And I did these slides on Friday, put this set together, and now we've got, by the time we were done Friday afternoon, we set another record high for fed cattle prices. This is the 5-market weighted average, Texas, Oklahoma, Colorado, Kansas, Nebraska, Iowa, Minnesota. And we actually had in the northern plains, there were some fed cattle that sold at 190 last week, but basically we're rocketing higher to ever higher prices on tighter supplies with fewer animals for slaughter, and gosh, we just got tighter supplies. But even with those tighter supplies, we continue to have demand. Consumers are continuing to buy. I think it also highlights that demand is there. We've got meat packers, beef packers that are scrambling to get tighter supplies, and they are bidding prices higher to get cattle. They've got orders for that beef. Not only, I'm not going to show a chart of it, but the cutout, the choice beef cutout got up to $330 last week, which is, it was up over $20 week over week. Just a huge increase in prices, which I think is particularly important that, we got past grilling, the big start of summer grilling season with Memorial Day, and prices took off even higher as we continued, to get more supplies. So, higher fed cattle prices. Calf prices are continuing to go up as well. We've got 500 to 600 pound steers, Southern Plains pushing 270. Higher prices for heavyweight feeders as well to get that next round of cattle in feedlots. Just been some incredible demand for cattle, for feeders, for fed cattle by meat packers, and appears to be some good demand so far. Continuing for beef, and so really that's a real positive story, and quite honestly much different than, say, the hog market if we looked at the struggles there, so which appear to be demand related, and some demand problems on the dairy side as well. But on the cattle side, we appear to have pretty good demand going on. I thought I'd show some of these prices in a little different way. I took this heavy feeder price, feeder steers, and the fed steer price, and what I did was I subtracted the fed cattle price from the feeder cattle price. And it implies sort of almost like a gross margin, if you will, on feeding cattle. And one of the things that I would highlight is, look at that 5-year average. We have this kind of movement where really we see this wider spread or slide from feeders to fed cattle. That typically happens late in the summer. We've got a very strong margin between the two, where feeder cattle prices have been bid up relative to fed cattle prices. So even though we're talking record high fed cattle prices, we have those feeders trading at a much a wider spread or an even higher price than normal. One of the things that would typically argue for is some lower feeder cattle prices, because we need ever higher fed cattle prices to make those pay. Yet we keep striking another record on the fed cattle side, and it makes those work. And the run in the futures market has allowed those feeder cattle prices to increase also. We finally had some movement in the last couple of weeks in the futures to kind of, I would argue, catch up to the cash and have prices next year really reflecting what we're seeing now. I think a good question is, normally later in the summer, June, July, August, we would see lower cattle prices. I think, we tend to have some better supplies. It's some slight increase in supplies. Boy, it looks like so far, that should happen seasonally, but it would look like so far that we may not see as much of that seasonal decline, because the demand for the animals remains. That demand for beef and tightening supplies is still with us. So I thought this was an interesting way to look at some of these price relationships and this pretty wide spread. we had our Southern Extension Economist meeting last week, and among us livestock economists at that session, we did a little 20 or 30 minutes on beef cattle expansion, because that's questions I think a lot of us livestock guys are getting. When are we going to see significant cow herd expansion? And so we kind of had a talking session about different questions that we're getting from cattle producers across the South, and really rain and profits really drive expansion, and certainly, you know, rain in parts of Texas that have been certainly hit by drought has held back the ability to expand, even though I think a lot of people have been thinking about it. And the other thing is we need profits. We need cattle prices, calf prices that are high enough to offset higher costs to allow folks to expand. Certainly, you know, higher prices is moving the profits that way. Rain is probably helping too, in terms to set up the stage for folks to be able to start holding back more heifers, reduce cow culling, and expand. So at least we've got some better conditions in place to do that. I'm going to show the full U.S. drought monitor. I was glad Yuri showed the kind of the Corn Belt, because that's what I really want to highlight. So this was the June 6th, so last week's map, and we continue to see improvement in the Panhandle of Texas, obviously with all that rainfall. But I think the thing to point out is continuing. We'll see what that development in Kansas and Nebraska is in terms of cow herd expansion, because that whole Great Plains is a pretty important beef cow region and beef cow production. So that would be a problem there. But I think the other thing to watch out for is to pay attention to is developing drought in the Corn Belt and drier conditions. You know, dry conditions may make it pretty darn hard to get to that trend yield record yield that Yuri had on that slide, which really reflects trend yields so far. Yet these dry conditions may keep us from getting that and support some higher feed costs. When certainly lower feed costs lately have helped support calf prices. So I think that's worth watching. I thought it was interesting too that Yuri included the map from the end of May a year ago. So the year-to-year comparison, we had dry conditions in the Corn Belt a year ago as well. So you know, I think that's worth watching from the feed cost front. But certainly we've got some rain has helped conditions for a lot of us. So, you know, I think those are two things worth looking at. The profit side, I used just a kind of a budgeting type look at costs, and certainly we have higher costs than we used to. But if we subtract those from higher prices, and I've got my projection for 24 on there, using that for 2024, and certainly what we would see is some expected increases in profits for ranchers, for cow-calf producers, not quite rivaling what we had in 14, but getting very close in terms of that. But certainly some profits to be able to allow us to expand are certainly on the horizon. You know, I think it's interesting to point out what the one reason that I don't have record profits compared to 14 is that we have higher costs compared to 14, and I don't have quite as high of calf prices yet, but certainly profits are there to kind of move us in that direction of the ability to expand from a dollars and cents standpoint. One of the things that I've been asked this question a bunch over the last, say, 6 weeks or two months with higher fed cattle and calf prices, are we seeing expansion already, or, you know, what might my strategy be? And my answer has been that, you know, so far increases in bred heifers and bred cows at auctions around the country have really lagged behind the percentage increase in cattle prices. So what I did was I've got 2 to 4 year old bred cows from Oklahoma City from the auction. Oh, shoot. I touched the screen and it kicked me out. Sorry about that. So I got 2 to 4 year old bred cows at Oklahoma City. I got 5 to 8 year old bred cows, and that should say 2 to 8. That's my typo. 2 to 8 year old bred cows at San Angelo at the auction, and I compared that to the percentage change in 500 to 600 pound steers from that graph that I had earlier, the 7 to 8s and the 5 market fed cattle, and so it's pretty easy to see on the cattle and calf side, we've got anywhere from 30% year-over-year increase to almost 50% increase in 500 to 600 pound steers. We've got these cows that are running about 20% to 35% increase in price. What I would suggest is that we are starting to catch up in terms of bred cow prices to the percentage changes in the calf market. So where the cow market had lagged behind the growth in calf prices, the cow market may be starting to catch up a little bit. We're still not there yet, and it still doesn't show the rapid increase in cow prices that we saw a decade ago in response to record high calf prices, but we're probably moving in that direction. So I thought I'd put that together just to kind of show these year-over-year percentage changes. Again, the cows reflect the monthly average May price versus May of a year ago. Those calf prices reflect 2 weeks ago. So that really the first week of June into May versus that same period a year ago. Returns to cattle feeders have been quite good. This is a kind of a long-running estimated series of returns, and we've certainly had about 8 or 9 months of profits in feeding cattle. That certainly fuels those higher fed cattle prices, but we're not back to the kind of the record levels quite that we saw in 14 and 15 in terms of fed cattle prices. But again, some positive returns there as well. I got this, early in the year, I wrote a little article about reflecting January's cold storage, and those were large numbers. I was getting questions about what's going on. Do we have too much beef there? What's happening? So the data came out for cold storage last week, and I thought I would just point out this decline in the amount of beef in storage. A pretty rapid decline, but it's also what we would normally see decline seasonally. And if you think about 3% less fed cattle, beef production, fewer beef cows going to market, the bulk of what's in cold storage are boneless beef to go into ground beef. So with tighter supplies of beef, we're using up what's in cold storage. So these, some folks' concerns about is this a problem? This problem has largely gone away, and so we really see cold storage reflecting what we're seeing in the cattle market as well, with less beef production. We're pulling those supplies out of storage, and those are going to feed our hamburger habits. And so really that's a move in the positive direction for cattle prices. Exports, there's export data came out last week at the end of the week, and so I thought I would just highlight that we are exporting less beef than we did a year ago. Quite honestly, with high prices, that's what we should expect. With less production and high prices, we ought to probably expect to export less beef, and that's certainly happening. A significant portion of that compared to a year ago is less beef to Japan, but so different markets are seeing an increase and others are contracting, but certainly exports are running below a year ago. Less production and higher prices. That's about what we ought to expect. I got the chance to, I had a lot of fun at the end of May. I got to do a chance to go to do a program on where we focused more on the lamb market, lamb, goats, and a little bit of cattle. And right after I did that program, the next week, the latest trade data came out. So I thought I would do a quick update in terms of lamb, in terms of imports. Anybody that follows the lamb market knows trade's a big deal. Imports can be a real stressor on our market. And when that latest data came out for April, I was pretty glad to see a pretty sharp decline in imports. Some of that's due to Easter being the first week of May. First week of April. It was April 9th this year. So we tend to see an increase in imports leading up to that holiday demand, and then imports fall off. Yet we saw a larger than seasonal decline in imports. I think that's another real positive in the lamb market. We certainly have tighter cold storage supplies, falling imports, little tighter production in the domestic market. All of those, I think, are positive and should be lending some support to lamb prices. And so I thought I'd throw that in just for something a little different, not just cattle this time, but I think this is really a move in a real positive direction for us. And I'll just close with our Southern Ag Today logo. If you get a chance to sign up for that, you know, all of us are writing stuff for that series, and I think you'd find some pretty useful things in there. So with that, Pancho, that's my last slide. So I'll end the show and try to quit sharing my screen here. There we go. Cool.
Here, thank you very much, David. Let me stop recording. So do you